Good morning, ladies and gentlemen, and a warm welcome to today's DEUTZ conference call on the acquisition of FFG Flensburger Fahrzeugbau. Please note that this call is being recorded and a replay will be available on deutz.com later today. Your participation in this call implies your consent to this. As always, please note that the disclaimer regarding today's presentation. And to get started right away, I'm pleased to welcome DEUTZ CEO Sebastian Schulte, the CFO Oliver Neu, and Lars Bölke, Head of Investor Relations and Communications, who are joining us from Cologne today. After their presentation, we will move on and be happy to receive your questions via the audio line in a Q&A session. And with having said this, I hand over to you, Sebastian. Please, go ahead.
Yeah, thank you very much. And also from my side, good morning, everyone, and thanks for joining this morning. And, whether you're here in the room with ourselves or dialing in from wherever it is, London, Frankfurt, New York, just to give a brief introduction. My name is Sebastian Schulte. I'm the CEO of DEUTZ, and I'm joined here this morning, as we just heard, by Oliver to my right, our CFO, and Lars Bölke, our Head of Investor Relations, Communication, and Marketing as well. And it's a significant morning for DEUTZ, and I want to actually say it very, very openly, very plainly. I'm genuinely pleased to be standing here today, this morning with you, because the announcement we just did is, and that's without question, certainly the most consequent strategic step this company has taken in a generation. Over the next 30 minutes or so, our CFO, Oliver Neu, and I will want to talk you through why we are acquiring FFG and what it means for DEUTZ, and what it means, of course, as well for you as investors. So let's get into that. So you see how we structured this morning. I'll take you and talk you through the overview and the strategic rationale. Oliver will then walk you through the deal synergies, the proposed transaction mechanics, and the financing, of course. And we will close together on next steps because there's a clear timeline and a clear ask of the shareholders. But let me now give you the headline picture before we build the details beneath it. So first of all, DEUTZ today signed a contract to acquire FFG, Flensburger Fahrzeugbau Gesellschaft. Flensburger Fahrzeugbau Gesellschaft is a premier European land defense system integrator. And let me give you the very, very simple version of why this works, and then I'll spend the next 20 minutes or so demonstrating it. So DEUTZ brings proven engine design, engineering, and industrial manufacturing scale. FFG brings established defense prime and MRO credentials, strong customer relationships across NATO, and serial integration expertise across more than 30 platform types. And together, and that's what's one of the exciting parts of that deal, together that combination creates something that does not currently exist in European defense. A single German domiciled industrial group covering the full land vehicle life cycle. That is the deal. But now let me give you the arguments for why it's the right deal, at the right price, and at the right moment. So 6 things matter here, and I want to name each of them before I go through them in detail. So first, our next DEUTZ strategy is delivering. We are not starting this transaction from a position of weakness or urgency. We are starting it from a position of strong momentum. Second, the European defense opportunity is historic. So NATO budgets are heading towards 700 billion and beyond by the end of this decade, and with Germany's Sondervermögen ring-fenced from electoral risks. So that's a unique environment. And third, FFG is truly a rare asset. Roughly 760 million euro in revenue in 2025, best-in-class margins, I can assure you that, and the 1.9 billion euro order backlog growing. And a pipeline that extends well into the next decade. Number 4, the combination creates something that simply, as I said before, does not exist today in European defense. A single German domiciled industrial group spanning propulsion, platform integration, MRO, and modernization across the full NATO land vehicle lifecycle. Fifth, the deal is extremely well structured. With approximately 1 billion euro in cash underpinned by secured debt and approximately 600 million euro in newly issued shares, and the operating cash flow of the combined group provides a clear self-funded deleveraging path. And sixth, the private owner families of FFG, today's owner, they are not exiting. They are joining DEUTZ as our new anchor shareholders, taking a 29.9% stake. And that last point matters a great deal to me, and I will come back to it later. So we signed today, July 9th. One part of the transaction requires new shares to be issued to facilitate the contribution in kind for the private owner families of FFG. And for this, we will convene an extraordinary general meeting on August 24th, and I will cover what we are asking of shareholders shortly. We anticipate closing and regulatory approval by late 2026 or latest Q1 27, and that is, of course, subject to completion of the required steps and customary conditions. And this is a well-structured, realistic timeline, and we will keep you informed throughout the process. Now, before I explain why FFG is the right acquisition, let me remind you of what DEUTZ is today. Because it's not the company some of you began following 5 or 6 or even more years ago. The transformation of DEUTZ from a single product engine company into a diversified 5-unit industrial platform is already strongly reflected in today's numbers. We've got 5 business units: engines, service, energy, new tech, and defense, and each carrying its own P&L responsibility, each targeting structurally growing end markets, each sized to perform independently of the engine volume cycle. That was the dominating factor years ago, but that's past. And in the financial year 25, as you know, group revenue reached a bit above 2 billion euro, up 12.7% year-on-year. And Q1 2026, as we announced earlier this year, underlying order intake grows 15% year-on-year, and our financial year 2026 guidance is 2.3 to 2.5 billion euro in revenue, with an adjusted margin of 6.5 to 8%. And we are very well on track here. And the market, as you see, as you know, as you follow, has already begun to appreciate the quality of what we have built and what we're building. And frankly, there is still a gap between where we trade and how well the business is performing today and how we expect it to perform it in the future. So there is more to come. Since the beginning of this transformation in 2022, our shares have appreciated by 137%. Revenue has grown at a 9.5% CAGR from 2020 to 2025, and consensus is projecting an acceleration to 14.8% CAGR through 2027 as the margin and growth story becomes clearer. The adjusted EBITDA margin has expanded structurally to 10.2% in 2025, and with further expansion in the consensus forecast, what we support as management. And this re-rating reflects growing recognition of the earnings quality that is embedded in our platform. What we're doing today is designed to build on that foundation, to add to the group an asset that brings best-in-class defense margins, contractually underpinned supported revenue, and a long-duration growth profile that simply did not exist in our portfolio before, at least not at this scale. Let me now turn to the context for the transaction, because it frames everything that follows. As said before, European NATO defense budgets are on a structural multi-decade growth path. From approximately 365 billion euro in 2023, projections now point to somewhere between 605 billion and 970 billion euro by 2030, depending obviously on the pace of the ramp up across member states. So that is at minimum a near doubling within this decade, potentially a near tripling. And these are not targets. These are treaty obligations and, in the case of Germany, constitutional commitments. The German Sondervermögen, as you all know, provides ring-fenced, parliament-approved capital that sits entirely outside annual discretionary budgets, insulated from coalition negotiations and electoral cycles. So that is a stability which supports this case strongly. And it removes the primary political risk that investors have historically assigned to European defense spending projections. So 3 strategic consequences follow. Focus on sovereignty means governments want local OEMs, local supply chains, and local partners. The need to build trust quickly means that qualified supplier status, which requires years of program participation, must be established now, ahead of formal award cycles. And the continued prioritization of land systems means Germany places domestic OEMs in its top 5 procurement priorities. And furthermore, the UK, to give another example, is directing 20% of heavy equipment investment into armored machinery. That is the market. And the question for DEUTZ was always, how do we capture it at scale and how do we do it before the window closes? And this slide gives you the answers to the timing question. The median age of NATO land fleet vehicles is currently approximately 28 years, meaning the average platform sits at the center of its midlife upgrade cycle right now, today. Platforms like the Leopard 2, introduced in 1979, the Fuchs, introduced in 1979 as well, the M113, introduced in 1960. So systems that have been in continuous service for decades are entering peak sustainment and modernization requirements simultaneously. The MRO opportunity, the upgrade opportunity, the capability enhancement demand, they are all crystallizing at once. FFG is one of the very few European companies with a NATO qualification, the program access, the certified serial production capacity, and the customer relationships to capture that opportunities at scale. And that is the right moment, and we think it's a narrow one. The qualification cycles and the procurement awards are happening now. So let me tell you a bit more about FFG. The Flensburger Fahrzeugbau Gesellschaft generated approximately 760 million euro revenue in 2025 on a revenue CAGR of around 50% per annum since 2023. And that is one of the fastest growing businesses in European defense, and is growing at generally best-in-class margins. Margin that compare quite favorably to publicly listed European defense peers. The business FFG employs more than 1,100 people across 9 locations, and its order backlog stands currently at above 1.9 billion euros. More than 90% of its revenue comes from NATO customers and the Ukraine, and less than 20% from the Bundeswehr alone. Which means the demand base is geographically quite diversified across the alliance and its close partners. It maintains active program relationships across more than 30 NATO platform types. Finding an asset like that, I can tell you, is rare. Also acquiring it on terms that are fair for shareholders, and I will come to the valuation in a moment, is even rarer. So the depth of FFG's program relationships, that is the single most important non-financial asset in this transaction. And I want to spend a moment on it. FFG serves more than 50 NATO nations and the Ukraine, and it holds program positions across the Leopard 2, Boxer, Puma, Marder, Fuchs, Fennec, and M113. And these are sustained, long-term program relationships involving deeply embedded technical knowledge and formally certified production status. The awarded contract backlog, as I said, is a multiple of the current annual revenue. So that kind of program access and institutional depth you cannot build in 2 or 3 years. Certainly not in time to capture the procurement cycle that is opening now. So FFG has accumulated over decades, and from the moment this deal closes, that entire network becomes part of DEUTZ. FFG is a systems integrator with its own platform pipeline, not just an MRO operator, although the MRO business is extremely excellent. We're very proud to have that part. So that distinction matters for how you model the long-term earnings, right? Because FFG also develops and delivers proprietary original equipment platforms. The VSEM 2 is a very good example. It's a multifunctional Leopard 2-based systems for recovery engineering and mine clearing, with 67 vehicles delivered across multiple nations and more to come. The ACSV is a modular armored support vehicle with 32 delivered across the Netherlands and Norway, and then also next program waves, the CAFs and the ACSV expansion, which represents substantial additional volume potential. And the point here is that FFG is not a maintenance business that happens to be growing. It's a system integrator with proprietary platform capability and a genuine OE program pipeline. And that distinction is extremely important for understanding the long-term earning profile we are acquiring here from DEUTZ. So the pipeline beyond the current backlog extends the picture much further. So the 1.9 billion euro backlog is itself multiples of FFG's 2025 revenue, providing strong near-term visibility, and the broader pipeline stretching toward 2032 and beyond is significantly larger in scale. So obviously I am not in a position to give you the precise quantum today. We will be able to provide more details once we progress through closing, but projects like the NATO ACSV platform expansion, the growing VISION 2 demand from NATO nations beyond the current three, the localized German CAFs production program and the sustained NATO modernization tailwinds all underpin, all support a growth profile that extends well beyond the current backlog horizon. So the visibility profile of this business is among the strongest I have seen in European industrial defense. Let me now address why 1 + 1 equals more than 2. The combination brings together capabilities that are genuinely complementary. DEUTZ brings engine expertise and manufacturing technology, certified military power pack technology across V6 to V12 configurations, with direct, immediate integration potential across FFG's platforms portfolio. We also bring global industrial manufacturing scale and engineering competence from our facilities in Cologne and Ulm. We bring a NATO-wide service network and reman capability for military drivetrains, as well as hybrid, hydrogen, emergency power generation, and electric propulsion technology. And all this is increasingly relevant as platform electrification accelerates. FFG brings platform integration and certified serial production capacity across 30+ NATO platform types. It also brings the prime and MRO relationships across Bundeswehr and NATO land programs and a proprietary OE pipeline. So together, the combined group closes a gap that no single German domiciled company has filled. A complete land vehicle lifecycle partner, propulsion, platform integration, MRO, modernization, all under one roof. No NATO customer today procures all four from a single European domiciled group. We will be the first. Let me also be direct about how FFG fits into the next DEUTZ structure, because I know some of you will think about organizational complexity. The answer is clean. FFG becomes the anchor of our defense business unit. FFG will continue to operate as a standalone entity, preserving its identity, its management, and its workforce. The management team at FFG has built something truly exceptional, and we are not acquiring them in order to restructure what they have built. We are acquiring FFG to accelerate what they have built and to use that platform to accelerate what we're building under mutually beneficial partnership. FFG's customer relationships and program knowledge remain intact and undisturbed, which means program framework access that DEUTZ defense business would otherwise require years of independent accreditation to reach is available to us from day one. And that accelerates our path to prime contractor eligibility by a strategically significant margin. This sets a bit of a background for the synergy discussion, and I will now hand over to Oliver to take you through the synergy overview, deal structure, and financing. Thank you very much for now, and I'll be back later.
Thank you very much, Sebastian, and good morning to everyone. I would like to first echo our shared excitement about welcoming FFG to DEUTZ Group. And part of that excitement is driven by the clearly synergetic nature of this deal. So let me be specific about synergies, because I know that this comes in everyone's mind. We are thinking about synergies across 6 categories. And the first one is engines. By integrating DEUTZ power packs into FFG platform portfolio, we create incremental revenue from internal sourcing, higher value creation through in-house manufacturing and selected defense components, and a higher utilization of our engineering and production sites in Cologne and Ulm. For service, talking about synergies means expanding the defense aftermarket and spare part business through NATO-wide service coverage, generating additional reman revenue from the overhaul of military drivetrains, and utilizing state-of-the-art DEUTZ spare part logistics for defense customers. This is a natural extension of what DEUTZ service already does today, but it's brought to bear on FFG's installed base. In our energy business, FFG's customer access opens additional revenue channels for DEUTZ defense energy offerings, so our hybrid and field power systems, into an existing and trusted customer network. For NewTech, this is about the integration of newer propulsion technologies. And for the existing DEUTZ defense business, we identify cross-selling potential, as well as utilization and expansion of existing DEUTZ defense partnerships, especially in unmanned and electrified defense solutions, with the potential of quicker ramp-up and additional cross-selling. This is about site optimization, about G&A savings on insurance, fleet, and overhead. I'm not in a position, unfortunately, to give you a precise service synergy number today, but I can tell you that the synergy profile across the 2 businesses we talk about is material, and that we will provide a comprehensive update once we are through to closing. Let me make the engine integration thesis a bit more concrete, because it is one of the clearest illustrations of why the combination makes operational sense. Our defense engine portfolio spans configurations from below 200 kilowatts to the growing market of above 800 kilowatts, covering the full power range relevant to FFG's platform portfolio. When you look at the TAR, the M113, the ACSV, these are precisely the platforms that require propulsion technology DEUTZ engineers and DEUTZ manufacturers at scale. The integration opportunity is a direct fit between the 2 product portfolios. And that is what we mean when we say that this combination was, in many ways, the logical conclusion of 2 strategies converging. It's about the right technology, it's about the right platform, and it's about the right moment in time. Next, let's talk about the service footprint. And here, let's take Germany as an example, because it is the most vivid illustration. We see the overlay of the DEUTZ service network distributed densely across the country, with FFG's established service locations in Flensburg, Hamburg, and across the north. And the density of that combined network, its proximity to Bundeswehr installations, and its proximity to the installed base of NATO platforms, it creates a service and logistic capability that neither company could replicate alone. It's about faster response times, it's about better parts availability, and integrated logistics. Defense customers measure platform availability. Procurement officers notice when the service partner can respond faster and get systems back into operation quicker. This is a competitive differentiator that will compound over time. On energy, I want to be clear that this is an emerging opportunity, but the direction of travel is unambiguous. Demand for hybrid energy ecosystems, for field power generation, for integrated energy management across armed platform fleets is growing. And FFG's customer relationships and platform access provide the channel. DEUTZ Energy provides the technology and manufacturing capabilities. Together, we have a joint offering that neither company can fully pursue independently. It is, so to speak, an important option value embedded in the transaction. One that I expect to become increasingly tangible as military platform electrification accelerates over the next decade. On manufacturing and roadmap production ramp-up, this is an operational important topic. FFG is currently scaling Plant 3 in Flensburg It is a new 100,000 square meter facility to support the serial production volumes that the CAFs and ACSV programs require. DEUTZ brings procurement scale, quality management system, and manufacturing excellence that directly accelerate the ramp-up. And this is not just a paper synergy. It is basically two industrial organizations combining their core competences at precisely the moment when production throughput is the binding constraint in European land defense. Program award bodies will notice that, and it strengthens FFG's competitive position in future bids. This concludes our synergy review, and I will now walk you through the transaction structure and the financial profile in detail. So let's start looking at the deal itself. The purchase price is approximately 1.6 billion, and that consideration and the deal is structured across three main components. The cash component is approximately 1 billion. The share component is approximately 0.6 billion in newly issued DEUTZ AG shares for a contribution in kind, which the seller families will then receive and retain as long-term shareholders. The third element is about alignment. The seller's families, they stay invested. There are some further variable performance-linked components, but they have agreed to a long-term focused investment agreement. They will receive also the right to nominate 2 members to the supervisory board. As our new anchor shareholders, the incentives going forward are the same as every other shareholders. That third element was a very important one to the owners of FFG, but also to us. It is a governance architecture that structurally aligns the interests of our largest new anchor shareholder with those of every existing DEUTZ investor going forward. And let me now take you through how the transaction is financed and how we manage the balance sheet from here. Well, as mentioned, the 1.6 billion acquisition is funded through approximately 1 billion in secured debt and approximately 0.6 billion in newly issued DEUTZ shares to the seller's families. The total debt facility is structured across 3 tranches: term loans, basically to finance the cash part, a revolving credit facility to give us some flexibility, and a guaranteed facility as a third component. It is underwritten by a consortium of 4 international banks, and that commitment was secured ahead of signing today. An independent fairness opinion prepared under the German IDWSA standard has confirmed that the transaction price is financially appropriate from the perspective of DEUTZ shareholders. On the cash generation, FFG's balance sheet carried a net cash position as of fiscal year 2025. And we have structured this as a lockbox transaction, which means FFG's cash generation above a certain threshold between December 31st, 2025 and closing accrues to DEUTZ. That provides a deleveraging engine basically from day one. The combined operating free cash flow of the group then provides significant potential for deleveraging. It's a strong cash conversion profile based on the FFG's high margin, based on a contract base that supports the deleveraging over the next 3 to 4 years until a level of lower than today's leverage. But of course, we are also evaluating all options, as we always did in the past, and that also includes potentially a 10% capital increase at a later point in time. On the earnings profile, well, the transaction is expected to be earnings per share accretive on pro forma basis, with further upside opportunities driven by synergies, the good FFG order book, and the strong pipeline. And let me walk you through that waterfall logic here. The arrows you see are only indicative and based on pro forma combination and dilution. Yes, the share issuance creates dilution, approximately 65 million new shares, bringing the total share count to approximately 270 million. But FFG's standalone earnings contribution at best-in-class margins on that base of approximately 760 million revenue provides them a strong starting point. From there, the accretion picture only improves. Near term, the crystallization of FFG's existing 1.9 billion order book and the early capture of cross-business synergies across engines of service add further earnings uplift. Longer term, the strategic synergies across the full 5 business unit platform and the conversion of the strong FFG pipeline into contracted revenue extend the profile considerably. We will provide more details once we are through the closing. But what can I say today already is that the direction of earnings on cash and on leverage is clearly positive from the point of close. And I will now hand back to Sebastian for some closing remarks.
Yeah, thank you very much, Oliver. Let me bring the 6 highlights back together, because what I want to achieve is I want you actually to leave this presentation with a full picture held in one place. So, next DEUTZ momentum, continued growth and 137% share price appreciation since 2022. The European defense opportunity, NATO budgets heading towards 700 billion euro and beyond. Germany's constitutional spending commitment removing the primary political risk. FFG is a best-in-class asset. Strong revenue growth, best-in-class margin, a 1.9 billion euro order backlog, 30+ platform types, 15+ NATO nations, proprietary OE programs with CAFs and RCSV expansion as the next program waves. So the combination, creating a European land champion, the only group spanning the full land vehicle lifecycle from a single German domicile. Conservative financing with a clear self-funded deleveraging path. And the FFG families joining as a new anchor shareholder. So that is the deal structure I am proud of. It serves the shareholders and it serves the combined group's long-term interests. This is a good deal for FFG. They are joining an established industrial platform with growing momentum and clear benefits to accelerating the business. And it's a good deal for DEUTZ shareholders. Fair value is independently confirmed. Pro forma, the transaction would be accretive despite dilution. The implied multiple of the transaction values FFG below other NATO land system providers and significantly below publicly listed European defense peers. Which brings me back to the timeline and next steps. We signed today, July 9th. We're convening an extraordinary general meeting on August 24th. To issue the new DEUTZ shares to the private owner families of FFG, we needed 75% supermajority of shares present and voting to approve the capital increase. The EGM convening notice, published in accordance with German law, will set out in full the terms of the resolution, the share issuance mechanics, and the record date for voting eligibility. Closing is subject to regulatory approval and customary closing conditions, and we expect closing by late 2026 or latest Q1 27. So a yes vote on August 24 is a vote for a stronger, more resilient DEUTZ with a defense platform scaled for the procurement cycle ahead, a high margin anchor business, and a committed long-term partner in the FFG families. Thank you. And I genuinely mean that. Thank you for your time this morning. Thank you for the rigor with which I know you will examine this transaction, and thank you for following the DEUTZ story over the past years. We have earned your attention, and I hope today we have earned your confidence in this next chapter. Oliver and I are now very happy to take questions, and for those of you joining us on the roadshow over the coming weeks, I look very much forward to continuing this conversation in person. Thank you very much.
Thank you very much, Sebastian and Oliver, for the update, and we are now moving to the Q&A session. For a dynamic conversation, we kindly ask you, dear participants, to ask questions via the audio line. To do so, please raise your hand by clicking the Raise Your Hand button. If you're dialed in by phone, please use the key combination *9. And we already have a question from Mr. Stüben. Mr. Stüben, you should be able to unmute yourself and place your question, please.
Hi, good morning. Thanks for taking my questions. A question on the margin profile. I think you said sort of best-in-class margin versus the European defense peers. Can you sort of clarify, what you mean by that? Are we talking high teens EBIT, or what are we supposed to be looking at, just so we can kind of figure out the rough multiple that you've paid? And then second, I guess, there's been a lot of discussions in recent weeks and months around, the need for tanks and vehicles going forward in this new modern kind of warfare environment. So maybe would love to get your thoughts on that in the context of the deal. And then finally, just given if you can confirm the pro forma leverage that you're expecting at the end of the year, and then also what that kind of implies for your M&A strategy in the next kind of 2 to 3 years. Should we expect this to sort of be on hold for now? I know you mentioned the potential for a share capital increase, so I just would love to get your thoughts on sort of M&A and the rest of the business over the next 2 to 3 years.
Sure. Thanks, Lasse. I will start, and Oliver will complement mainly on the second half of your question. So, as you see, and as you and I think Klaus also asked the same question, we did not disclose the EBIT or EBITDA margin in specific numbers, but obviously it can give a bit of an indication for that. So, EBITDA is rather slightly above 20, and not only in the high teens. In terms of multiple, what I can say and what we're prepared to say is that if you look at the EBITDA numbers of 25, the current 26 expectation, and also 27 plans, we are on average on a level that one could fairly argue of a multiple between 8 and 10 times.
Yeah, coming to your question on the...
Oh, sorry. That was, sorry. I was just, then you asked on sort of the future perspectives of land vehicles versus unmanned systems. And, I answered in a similar way like we answered when we talked about our growing business on a smaller scale, but the growing business in unmanned systems. I'm personally convinced it's not an either or. Both routes, both paths will play an important role in the future. Obviously, unmanned is growing fast. That's clear. The Ukraine war has shown that, but the Ukraine war is also showing that sort of the traditional vehicles will remain and will be very relevant for a long period of time. So it's not, that everything will become unmanned shortly. It's also not that, unmanned is only a temporary phenomenon. So we expect the traditional as well as the death tech perspectives both to be relevant for decades and beyond. So that's why also here diversification is something which is very, very important in the portfolio of any defense company. I don't think it's a question of beliefs, it's a question of portfolio. Now back to you, Oliver.
Yeah, and on the leverage question, Lasse, thank you very much for that. Apparently will drive up leverage a bit. So we are acquiring a target that has strong cash generation capabilities, that has a positive net financial position, as I explained throughout the presentation. But of course, the total leverage of the group, which was at 1.7 at the first quarter, the last publication, that will go up by 1 or a bit more throughout the year. But then that is important with a clear path for very strong deleveraging over the next 3 to 4 years to come back to levels that are then expected to be even lower than today.
Yeah, you also asked about future M&A, and yes, that remains always a possibility. I mean, clearly with that step in defense, that's a major step in our defense business unit in particular. The business unit or the defense business of DEUTZ after the completion of that acquisition will likely be, in terms of revenue and certainly in terms of profitability, the strongest pillar of the combined group. So, however, when we look at the other growth paths we have decided to play in, we should mention definitely the energy business. We started, as you know, from pretty much 0 3 years ago. And this year, we are already pro forma on a 330 million euro revenue level with also very solid margins. And we see in that vertical high growth potential organically and potentially also unorganically. we certainly do not envisage a transaction of the magnitude of that one in the next 2 or 3 years. But certainly we are still prepared and able to selectively grow also in energy, because what we have in mind here is very clearly to extend the revenue in the energy business also significantly in the next 5 years. So DEUTZ will grow in particular with the defense vertical and with the energy vertical, both organically and inorganically. This is not the end of the growth story. Certainly not.
Okay, thanks very much.
Well, thank you, and we move on to the next participant, Mr. Augustin. You should be able to unmute yourself and place your question. Mr. Augustin, you should be able to unmute yourself. Well, Mr. Augustin sadly just dropped out of the call, I guess. So we move on.
You can hear me now?
Wait from...
Is it? Do you hear me now?
Yes, we can hear you.
Oh, great. Thank you. A couple of questions I have. The first is actually on the mechanics of the price to be paid. So it's around the 1.6 billion give and take. The question is, if the share price changes now, does FFG owners always stay at 29.9%, or can they actually grow above 30%? And if the share price would fall, is it then that the debt side would actually increase to match still the 1.6 billion? How does this work?
No, for the share price was, as it is customary in a Sachkapitalerhöhung like what we have envisaged here. So the share price has been fixed with the signature of the transaction this morning based on numbers of the last weeks. So there is the share price is fixed, and we have agreed with the sellers' families on quite customary rules and procedures in terms of hold periods as well as standstill periods. So the idea is very clear, or the concept, not the idea, the concept is very clear, that the 29.9% will be a cap on the one side, and on the other hand, there will also not be, a quickish sell-off of that shares, so that we have a very stable anchor investor going forward here. I hope that answered your question, Mr. Augustin.
Yes, thank you, definitely. The next one is, I was just having a bad line. Could you please repeat the leverage multiple you just stated a minute ago?
Yeah, happy to repeat that. So what I said earlier is basically that we come from a leverage of 1.7, as you saw in the Q1 figures, and that transaction will certainly, on a pro forma basis, then drive up leverage by 1 or a bit more compared to the level we are coming from. Important point here is to see that we are buying a company that has a net cash position on the balance sheet, and the combined group has a very strong cash flow profile to go for a deleveraging going forward. Over the next 3 to 4 years, we are expecting that the leverage after that initial increase is coming back to levels as of today, or even slightly below.
Thank you for that clarification. And then also on the slide, you state that around 90% is MRO revenue base of FFG. Does that imply that actually 90% of the sales currently are, let's say, service sales?
It is, we call it MRO plus, so it's not only, traditional service sales, it's also modernization and of vehicles, also a fair bit driven by demand in the Ukraine right now, and that's a bit perspective for the past. So in absolute terms, that MRO business is expected to remain more or less on that level. But what the business will add on is a fairly strong ramp up in vehicle sales, production vehicle sales, because that's, like I explained earlier to to the presentation, that's one of the sort of transformation or growth trajectories FFG has been successfully undertaking in the last years, coming from a company being very much focused on MRO, but now adding more and more the OE capacities on top with the ramp up of the new production facilities, with the ramp up of the various programs we mentioned throughout the presentation. So the 90% is sort of a baseline on which more growth and profitability will build on.
Understood. And to the order backlog, Germany has signed a CABS program of around 1 billion or announced in December. Is that already part of the 1.9 billion backlog, this 1 billion for Germany, or is that actually comprised in that additional potential?
That is in principle part of a combination of the backlog and the pipeline, because FFG is here acting as a partner of that contract with the Finnish Patria Group. So we will not, at this point in time, we cannot break down in the public the order backlog in detail, but you will expect, or we are expecting more of that program to be incorporated in the future backlog.
All right. Thank you very much, and congratulations to the deal.
Thank you, Mr. Augustin.
Yes, thank you very much. And we turn to one participant who's only able to do questions with our chat box. I'll read this out. Mr. Ringel is asking, have you finally decided to develop an engine for the plus 800 kilowatt power plant?
We are still investigating here. And certainly the combination with FFG helps here, but obviously we are, as normal, we are investigating what is the market demand, because the market demand obviously needs to be there in a sufficient manner to support the development costs we're incurring here. So we have made decisions to continue developing engines sub 800 kW for the military use. That's clear. That's actually ongoing. But for the 800 plus, we're still in investigation, but obviously the market potential has, with that step, now certainly increased.
Okay, thank you very much. And Mr. Ringel is adding up to another question for another topic. Indication for cost of debt on the additional 1 billion euro.
Yeah, we have agreed on the conditions with the banks that are customary conditions, good conditions, if I can say that. So that's a typical margin grid you agree with the banks on a leverage depending basis. It's even compared to the conditions we currently have a slight improvement. So I cannot disclose specific figures here apparently, but yeah, it's a typical margin grid on a Euribor base interest rate.
Yeah, I also see, Mr. Ringel, another question on visibility and legal obligation to update raise medium-term targets. As you imply with your question, that's too early right now. What we are clearly saying, and we also issued that or made that statement in our press releases, that the path to the midterm target of 4 billion revenue and 10% margin, we will be there much quicker than what we previously outlined. But exactly when and how, that is something we will now develop jointly with the FFG team throughout the summer. And as soon as we have the knowledge or the obligation, or typically the one goes in line with the other, we will certainly update. The only thing I can say, we anticipate or we expect a very, very strong acceleration of that path. I mean, the one aspect is obviously the top line. I think here it's very easy to do the math right now. The other aspect is obviously the bottom line and what we can indicate, and actually what I have indicated already quite clearly about 15 minutes ago. The FFG business is, in terms of profitability, EBITDA and EBIT, obviously highly margin accretive to today's group's numbers. So that's why we're probably being even faster at the 10% margin target than at the revenue target. But, ideally, obviously, and that's where we're committed to, we raise revenue and we raise profitability. And that is the best thing, what we can deliver and what you would like to see in your models as well. Happy to help.
Yes, thank you very much. And we have another question, and because we took one from the chat box, we'll refer to that one as well. Any indications on DNA of FFA in terms of sales? How much potential CapEx needs for the new growth at FFG?
Yeah, I will also give only indicational numbers right now, given the early stage of the acquisition. But where FFG comes from, the DNA is relatively low. Certainly compared to an industrial environment, industrial structure like we have at DEUTZ. On the other hand, for expanding the capacities at FFG, they're building a new facility up north in Flensburg. That's all publicly available also by, their FFG's press releases of the past 6 or 12 months. So obviously that goes in hand with the investment, but I believe, or I know that the investment in that new facility is managed very rigorously, and we have obviously fully incorporated the CapEx in the planning, and investment is well on the way. And then this will in the future up slightly DNA, but still not on levels that we know from industrial context. The reason is very simple, because we do not talk here about highly automized production and assembly like what you see in automotive. Even in this sort of defense context, you speak about a ramp up to a serial production, but it's not a serial production like you have in automotive or automotive near production. We don't talk about tens of thousands of units. We talk about hundreds or dozens of units, right?
Well, thank you very much. And I'll wait for maybe a risen hand for a question, because in the meantime we have received no further questions. And for that, we come to the end of today's conference call. Thank you for joining and the shown interest in DEUTZ. Thank you very much, Sebastian and Oliver, for the presentation, the update, and the time you took to answer the questions. From my side, I wish you all a very successful end of the week. And for some final remarks, I return and hand over back to Sebastian, which concludes the call for today. Thank you very much.
Yeah, thank you very much for dialing in, for listening, for asking questions. We're very happy to make that call this morning here. And let me just conclude a couple of highlights from my point of view. We are doing a landmark transaction, landmark acquisition from DEUTZ perspective. We're creating a new European champion for military vehicles. The objective is clearly to become a prime here. FFG has been growing extraordinary over the past years, both in terms of revenue, both in terms of profit. And, with that acquisition, we're combining here with, and I'm convinced of that, certainly one of the most attractive and profitable defense companies available in Europe. The purchase price or the deal structure is a very smart structure, because it combines a very fair valuation with an alignment of interest between buyer and seller, so the future representation of the seller's family in a very sort of customary way in the future shareholder structure. And as DEUTZ, obviously, we're taking an important step to accelerate our profitable growth, to continue or to be faster at the target picture of next DEUTZ that we have developed. And in that sense, it is exciting news for us. We appreciate that, particularly those of you guys running your models, you will need to make some significant adjustments, of course. It's not a bit adding a bit of euro revenue here or units and engines. And what I can say that our investor relations team is obviously happy to support you on that, because we're truly creating shareholder value here and looking obviously forward to go through the next steps on making that transaction not only a signed transaction, but then a closed transaction, and then leveraging the strength of both companies and creating value also by the various synergy fields that Oliver has just presented. All in all, thank you very much for dialing in, and for those who are on vacation, thank you even more for dialing in, and enjoy the rest of the vacation, and keep writing good reports on DEUTZ, and for the investors, keep buying the stock. Thank you.